Korea's financial regulator just changed the rules for how banks handle early loan repayment, and the numbers behind closed doors are shifting. The second quarter is almost over. Credit card defaults have picked up, and lenders are rethinking their playbook in ways that matter for anyone with a loan in Korea. It's Monday, July 20th. Let's break down what's happening in Korea's financial sector. KB Financial Group announced it would lower early repayment fees on credit loans, responding to mounting pressure from borrowers trying to refinance. The move signals banks are losing pricing power as competition intensifies and regulatory scrutiny tightens. Korea's debt servicing costs remain stubbornly high despite the central bank holding rates steady at 3.5%. Here's what the numbers show. Corporate loan delinquency rates rose 0.08 percentage points in the second quarter, the first uptick in 5 consecutive quarters of decline. This marks an early warning sign. Defaults traditionally spike when economic headwinds intensify. The Bank of Korea continues to monitor household debt closely, with total credit growth now at 1.23 trillion won, up 2.1% year-over-year. So what does this mean for financial institutions wrestling with margin compression and regulatory pressure? Earlier, we said banks are lowering fees and facing tighter margins. Here's what that actually means for compliance teams and risk managers. Lenders must now calculate the true cost of customer acquisition against shrinking net interest margins, forcing difficult choices about portfolio mix. Anyone managing capital adequacy ratios this quarter should factor in both rising credit costs and the regulatory pressure on pricing power. That's today's AI Prism Finance Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a WAN IFRA award-winning series. We'll be back tomorrow.